Hello and welcome to this Magellan update. My name is Matthew Webb and I'm here with Hamish Douglass, co-founder and chief investment officer of Magellan. Hi Hamish.
Hi Matt, good to be with you.
Hamish, it's been a fascinating couple of weeks for Magellan. Can you give us a bit of flavour for how you're responding and how you're feeling about current events?
Yeah, well, it's certainly been a fascinating few weeks, Matt. I would say there's three separate issues that has occurred in the last few weeks. The first one was the resignation of our Chief Executive Officer, Brett Cairns. Clearly, we're disappointed that happened. He resigned for personal reasons, but it's also important to understand what Brett's role was at Magellan. About 3 years ago, I used to be the Chief Executive and the Chief Investment Officer at Magellan, and 3 years ago, Brett changed roles. He used to be the Executive Chairman looking after some special projects, and he came in as Chief Executive and took over all my responsibilities for the non-investment functions at Magellan, and I retained responsibility for investment functions alongside John Sevior and Matt Williams in Australian equities and Gerald Stack in infrastructure, and I predominantly now look after the investment activities for the global equities business. But Brett was running the non-investment activities side of the business and really had no impact or no involvement in our investment activities. With Brett's resignation, we've asked Kirsten Morton, who was our Chief Financial Officer for the last 8 years, and actually operations reported to Kirsten, to step into the interim CEO role, to take on those non-investment activities at Magellan. And Kirsten's doing an outstanding job. In the new year, the board will make a considered decision to appoint a new Chief Executive to look after those very important non-investment activities at Magellan. I will remain focused on the investment side of the business. I stepped away from being Chief Executive a few years. Interesting, people got really concerned, but I used to do all that, but I'm not going to do it. I'm not going to step back into that role. Investments is where I should be focused, and it's where I am focused in that. So that's Brett's resignation. Disappointing, but these things happen from time to time, but it really doesn't affect any clients. We will have the right person in the role looking after that part of the business. The second event that's happened this week, we announced that St James's Place, our largest client, has ended their mandate with Magellan. First of all, I'd say their mandate was a different mandate in global equities. It was a very bespoke mandate. It had nothing to do with any of our other funds or client business. It was their own fund that they manage, which we were just managing for them. So their decision to withdraw doesn't have any impact on any other clients, and importantly, it doesn't have that larger impact on our business. They represented about 12% of our revenues. No other clients more than 3% of our revenues. So absent St James's Place, we're incredibly diversified at Magellan, but even absent St James's Place, we've got a very, very strong business, very financially strong. We've got very substantial assets at Magellan and very substantial cash. We've got no debt whatsoever, and even in the absence of St James's Place, we'll still have some of the highest operating margins of any fund management business in the world, with very substantial cash flow. So there will be no impact on the investment activities at Magellan because of the withdrawal of St James's Place. Of course, we're disappointed in that, but at the end of the day, it's their decision to make. We respect their decision. We are fiduciaries of their money. All our clients' monies, we're fiduciaries, and they can choose, if they want to retain us. It's inevitably over an extended period of time, clients come and go. St James's Place had been with us for 8 years. We would have loved them to have been with us for longer, but that's a fact of the matter. There are clients who turn over from time to time, but it doesn't have any impact on any other clients, and it certainly doesn't have an impact on our investment activities at Magellan, but clearly disappointed in the last, after a very, very strong relationship with a fabulous group at the end of the day. And the third one's probably the most difficult issue for me personally to talk about, and that's been the media interest in my marriage separation. At the end of the day, people have tried to create an image that my wife and I are in some nasty divorce. Nothing could be further from the truth. My wife and I remain incredibly close. Actually, we spend a lot of time sharing a house together. We're spending the whole Christmas holidays together. After Christmas, we'll be going away together as as a family. She, in the last 2 weeks, has been a rock of support. The first thing she did was drive down from our farm to join me in Sydney for a few days after this sort of speculation that we're in some form of messy divorce. And I don't understand why people would want to try and invent and create circumstances trying to say that this is going to have an impact on Magellan, where if they actually knew us and knew what was going on, we are completely united and effectively together, and there's no nasty divorce. And people were saying we're about to dump our shares in Magellan. This is just absurd. We've never sold a single share in Magellan. We actually put out a statement that we don't have any intention of selling any shares in Magellan, but people are just making this stuff up, and I don't know what people's motivations are, but really there's a time where people should really stay out of people's personal lives, and particularly not try and invent situations which just aren't true. That's difficult to talk about, but I think as clients in our funds, they have a right to know when they've read some of this stuff in the newspapers. I don't like talking about that. My wife has been absolutely wonderful, and as I say, we are the closest as friends. A difficult circumstance when you're separated, but we're spending a lot of time together as well. And so, I'd ask people just to respect our privacy on that. And when I look about, how has it impacted all these sort of uncorrelated events in the last few weeks, the support from colleagues and the atmosphere in Magellan has been remarkable. We had a Christmas party week before last. It was probably the best Christmas party we've had in 10 years. Chris Mackay was at our Christmas party, the co-founder of the business. Wonderful. Chris has been a wonderful support to people in the business in the last few weeks. So I can tell you, people are getting on with their jobs. People at Magellan have pretty thick skin. They know what we do. They know much of this is being beaten up by people. And I'd also like to thank Kirsten. Kirsten has stepped up, interim CEO. She is working around the clock. Obviously, there's a lot going on at the moment, and she is taking the heavy workload. I'm really focused on investments. I'm at work. I haven't missed a single day's work despite all this noise. I was speaking with Michael Morrell this morning about the Iranian and Israeli situation, trying to weigh up the risk for oil markets at the moment with my macroeconomic colleagues. So I've been, focused on what's going on in the portfolio and other things, despite all this sort of noise going on at the moment.
Thanks, Hamish. I appreciate they're difficult questions to answer, but appreciate you in taking them. Also must say from personal experience, I think it's really galvanised people here. I think people at Magellan are incredibly passionate about this business, and we're really proud of what we've built for investors over a period of time. But thank you for taking those difficult questions. Can you just sort of touch on what you're trying to achieve for the global equity strategy, just to remind people at this point?
Let's just start at a very high level. We're not about relative returns to an index of the market. We don't know any client who has retired on a relative return concept. When we set the business up and we launched the global equity strategy, we asked ourselves a very simple question: what actually matters to people? And we came up with two fundamental issues. One is the return they earn on their money and the probability that they have their money returned to them. So they're very two important concepts: returns on the money and the return of the money. So we set two very clear objectives when we set this strategy up. We said, what rate of return do we believe will be highly satisfactory for investors over time? And we set ourselves an objective in the Magellan Global Fund of a return of 9% per annum after all our fees, a net return to the clients on average over time. Of course, that's not going to be a return every single year. And we actually also said is we want to make sure we return their money. And we set an objective to have a fundamental capital preservation element of our strategy. And if you have a look what's actually happened over time, we have beaten the 9% per annum return objective in every period you want to measure over time. And we've done it with less than or around 50% of the downside risk of markets when something's gone wrong. And I think that's very, very unique. There is a focus, an intense focus about, how have you gone about against the stock market in a particular point in time. I'd say to people that if you measure our performance over time, we've actually beaten the world markets 85% of the time on a rolling 3-year basis. People are picking a very particular point in time now. They're fine to do that, but it's not what we're trying to do, and we've done it with half the risk of the market. So if people are interested about the return they get on their capital over time, and they're concerned about the preservation of their capital, that's what we're trying to do. We've never promised people we're going to beat the market in every 6 or 12 month period, because we look nothing like the market. The market has a very different risk profile to the strategy that we are running. It is true we have underperformed the market in the last 12 months. I have personally made a few mistakes in relation to China. We were overweight some Chinese stocks. We've fixed that, by the way, in the portfolio. China is a very small part of our portfolio today. You don't get everything right, and markets can be very humbling, but the portfolio has still delivered 12% return in the last year, which is above our long-term objective, and we remain very confident that the strategy will still be this low-risk compounding capital that we set out from day one to achieve for people.
I know we're not a relative return house, but I want to sort of pick up that topic a little bit and talk about 12-month returns. Again, not an appropriate time frame, but if we look at our sort of 14.5-year history, in down markets, the funds perform really well, net of fees. So it's, average excess return over a rolling 12-month period is about 12% per annum. That's great. In up markets, it still outperformed, but in a much smaller manner, so about 1.5% per annum. But then when you get to really, really strong up markets, like 20 or 30% up, which admittedly don't occur all that often, the strategy does tend to underperform. So I'm just curious, given the events of the last 12 to 18 months, is there any aspect of the process that you're having a look at?
The answer to that, Matthew, is we're not about to change course. We're not going to change our objectives around the preservation of capital, around running a strategy that has much less risk than the markets. We've seen an outperformance on the downside of 20 percentage points. We've now seen a difference on the upside of 20 percentage points. The markets were up over 30 and we were up 10, or we're up 12 and the markets were up 32. So we've seen in a 12-month period, if you look today, it's less than that today. Did we get everything perfectly right? No, but are we about because in one period out of nearly 15 years, we've had an underperformance relative to the market. Are we going to change that objective where we want to get a very decent return on people's capital and we make sure that we get the return of their capital irrespective of market conditions? No, we're not about to change that. And why not? Because we believe it's fundamentally right. I'm not going to start chopping and changing a strategy because my ego's been bruised. It's not about me. We are fiduciaries of everybody's money who is listening to this. It is your money, not my money. It's not about my ego. I'm not about to start chopping and changing and swinging for the fences because I'm somewhat embarrassed about just underperforming a market in a 12-month period. We have great confidence in our strategy and our remarkable team here. At the end of the day, this movie hasn't ended yet. There is a lot of risk in these markets. We're conservative. We're a conservative investor. Markets will turn. I think, again, people appreciate having a conservative approach here. We often say in Magellan, it's like we're the designated driver at a wild party at the moment. Charlie Munger has observed that he thinks the current period in history is the most extreme markets he has seen in his lifetime, and he's 98 years old. He says it's more extreme than happened in 1999. So we're not about to change and suddenly take more risk with our clients' capital because of a sort of underperformance versus a benchmark or a market that we look nothing like and has a very different risk profile to us. That the market doesn't have a view on risk. It doesn't have any downside protection built into the market itself. We're building something very different into the strategy, but we haven't done everything right, and we've corrected a few things in the last 12 months, particularly around China, and I bear full responsibility for that Matthew. And the last thing I'd say is I love some of the investment greats of the past, and Phil Fisher was one of my heroes. He wrote a book and it said conservative investors sleep well at night. At the end of the day, when you're with Magellan, you're with a conservative investment firm. Being a conservative investor hasn't been, you've kind of been outside the party in the last 12 months. So be it at the end of the day. And as I said, it's not about me. I've got thick skin. I can take the ego bruising, but I'm not about to start playing with other people's money because of that and acting in a way that I don't think has prudence in the current market environment.
Thanks, Hamish. I appreciate those reflections. We, hopefully you and a lot of our listeners are about to head off on hopefully a well-deserved end-of-year break. During that break, what are you going to be thinking about? What are you worried about for the year ahead in 2022? Phrased differently, what would keep you up at night at the moment? What are you keeping an eye on?
Well, I'm not sure I'd phrase it as keeping me up at night. If there's big risk events in the world, we're inherently conservative at the end of the day. So a lot of risk doesn't probably worry me, but can I see a lot of risk at the moment? I think the big story of 2022 is what happens with inflation in the world. It looks to us that a lot of the inflationary pressures have been transitory, that they've been caused by the pandemic. And the reason I would say that is because a lot of people were all locked down in their houses. They weren't able to go on the 3 holidays over the last year and a half. They weren't able to attend all the restaurants and the movie theatres. They were at home, but they had income because the government's largely provided the income, and they were spending less than they used to spend, so their savings rates have been high. And whilst we were locked at home, believe it or not, the demand for manufactured goods in the world went through the roof. We had more monthly demand for goods than we've ever seen in history. So factories were being asked to produce more than they've ever produced before. At the same time, supply chains, particularly in Southeast Asia, were being impacted by COVID lockdowns during that period. It's not surprising that shipping costs went through the roof because there was suddenly more demand for containers than ever had been demanded in history. So we've seen the cost of manufactured goods go up substantially because of this demand imbalance. If we're able to totally reopen the world and the vaccinations work and we get through this Omicron situation, and Omicron's confusing, making it more difficult here on the inflation front. If we reopen, people won't go and buy the extra bread maker and the extra television and the extra set of stuff for their porches and backyards and fire pits, whatever people were buying it when they were locked down, let me tell you, on a global basis. People will start spending their money back on services instead of these manufactured goods. And as that happens, the pressure in the supply chain should come down and we should roll out of this extreme inflation period. But here's the catch. The catch for 2022 is really driven out of the United States, and it's driven by something called Omicron at the moment. If it is that we go through a period where we are further locked down, or we won't be able to go and rotate into services like travel, experiences in restaurants, and we start spending it on manufactured goods again, this inflation story may not roll over and it may not be transitory. And just at the moment, consumers around the world are really starting to feel these inflation pressures because finally it's getting through the manufacturing process. It's now getting into large consumer price increases. We know in the United States in this winter quarter, people are going to be seeing their utility bills up 15 to 30%. And in the United States, inflation has become the political issue on every television network because of the midterm elections for Congress in 2022. So the Republicans have zeroed on inflation as the big issue. They've got Democrats on the back foot, and now consumers are going to start to experience it. The issue is if consumers' expectations start to change and we don't get this total reopening and a rollover of this, and the expectations change, we could find by mid-next year this game is up. That expectations have moved enough on inflation, wages then start moving on inflation, and the Federal Reserve is way behind the curve in what they're anticipating to do. This is all about the United States because they set the risk asset pricing for the entire world. So if the Federal Reserve is forced to stamp out inflation mid-next year, it is hold on to your chairs these markets are so wound up in so crowded trades. If that was to happen, people are in for a rude shock, and people's great experience at this party of 2021 will be the great unwind of 2022. What probability do I put on that? 30%. I still think it's likely that we're going to reopen and roll over through that. But if this happens in 2022, I think people will say, thank God we're with Magellan, because we have half our portfolio in super defensive assets. So it's almost the mirror image of us being conservative through 2021 will be the mirror image if this type of thing was to happen in 2022. What could trigger it? Well, I was speaking to Michael Morrell this morning on the Iranian-Israel situation. Clearly we've got the nuclear talks going on. The assessment from Michael is they're going to fail. If they're going to fail, we're hearing politically there's increased pressure in Israel to do a preemptive strike then against the nuclear facilities. I don't know what probability to put on that, but then we're asking Michael, well, what would happen if that was to occur? His view that Iran would almost immediately then start striking the oil facilities in the Middle East. If that was to happen, the game's up on inflation. So there are kind of things we're not even looking at, or markets are not looking at, that could trigger a major market event that we're not even thinking about at the moment. So there is real risk out here. As Charlie Munger said, these are the most extreme markets he's seen in his entire lifetime. And I think just a bit of sober reality and a bit of prudence is required here. Instead of this entire focus, you've missed out and isn't that terrible? As I say, we're the designated drivers at this party at the moment, and there is some risk to get through in 2022. We may get through them and everything will be fine, or we may not get through them. But if we have a major event in 2022, people shouldn't be surprised. We're not saying it's going to happen. I'll put about a 30% probability on that. And this Omicron event is just confusing the picture. It's actually increasing the risk of downside. This is going to spread around the world like wildfire in the next 6 weeks or so. But what the implications of that are is hard to gauge. A movie's playing out. We'll all be smarter in the next 6 weeks of what that plays out. But it's not really about Omicron. It's the impact it could have on this inflation story.
Thanks, Hamish. I want to finish on a positive note. Can you talk a little bit about the portfolio, just to give people a flavour for what that looks like at the moment?
Yeah, well, I'll run it through at a very high level. We've got a collection of the world's best businesses at the end of the day, and it's roughly balanced 50% between very defensive businesses. Our defensive portfolio is made up, we have some restaurant companies that people know, Starbucks, Yum Brands, and McDonald's. They are going very, very well, those businesses, nothing to worry about. We then have a number of great consumer staple companies in the world. 3 of them are incredible. Nestle is one of the strongest companies in the world in the food industry. Its business, run by Mark Schneider, is hitting the ball out of the ballpark at the moment. P&G has gone through a turnaround a number of years ago. They have probably the strongest brand portfolio in the world, going very well, and the other one is PepsiCo, which owns the incredible Frito-Lay franchise in the United States. Again, it is getting stronger and stronger every day. That is one of the world's best businesses. And our 4th one is we've got an investment in Reckitt that owns brands like Finish and Dettol and Napisan and Lysol, which is the biggest disinfectant brand in the United States. They're going through somewhat of a turnaround. They've got out of their infant formula business in China. It's got a new management team from PepsiCo in there. We're pretty confident around the turnaround of that business, and they've got great brands. That one I'd put as there's more sort of idiosyncratic risk around that. We've got some utilities in the United States that are very, very defensive and should give us consistent returns over time. And we've got an infrastructure stock, a telecommunications tower and fibre business called Crown Castle, which has done very well. They're underperformed the market, but you shouldn't have any sleep over those. And we've got a business, Novartis, which is Switzerland's 2nd largest company, a healthcare company. It's very, very cheap at the moment. So very comfortable on the defensive side of the book, notwithstanding it's underperformed the market in the last 12 months. But if anyone looked at the results of these companies, you wouldn't be concerned about them at all. Super, super high quality. And then you think about our growth part of the business. We're now down to less than 4% directly in China. We've held our Alibaba position and we're out of Tencent. And then the rest of them are very familiar names that people know. Microsoft's our largest investment. Very, very confident. We've made 12 times our clients' money in Microsoft, and we still think it's got a fabulous decade ahead of it. It's on the right side of every structural change you can imagine in computing at the moment. Alphabet, which owns Google. Google is one of the unique businesses of the world. They also own YouTube in a space where we've got a transition away from traditional television and pay television into an advertising-based model of video. Likewise, we own Netflix. It's a new investment. It's doing very well, but that's a 10-year story of compound returns again, where Visa and MasterCard have been very, very long-term investments. A few clouds around part of their businesses at the moment. We've got other businesses like Intercontinental Exchange, which is run by one of the geniuses of the financial services industry. Incredible what they're doing in the mortgage market in the United States, digitalising the end-to-end processes. This is going to be an enormous business for them. They own the New York Stock Exchange. They've got some of the great futures contracts of the world. So a great collection of businesses. So, am I confident about the sort of objectives of this strategy over time with the collection of businesses we have? Yes, in the long term, the market's a weighing machine, and it's going to weigh the results. The results of these companies are very, very strong at the moment, notwithstanding the portfolio has somewhat lagged the market. It's not in the risky end of the market. The risky end of the market has been where the real returns have been generated on a short-term basis. The conservative approach and the quality of this portfolio, I'm comfortable with. And every time I speak to management and I go through the transcripts of their results, I come away with a lot of comfort about what's likely to happen in the years ahead in owning this collection of businesses.
Thanks, Hamish. Appreciate your time today.
A pleasure, Matt.
And thank you, everybody, for joining us. We wish you and your families a wonderful end-of-year break. I'm sure all of you have deserved time off. We thank you very much for your support and look forward to speaking with you in 2022.